Hey class, we're going to go over the basic managerial accounting concepts and principles in chapter 14. Our first one, we're going to talk about the basics. Managerial accounting provides financial and non-financial information to an organization's managers. And when you think about managers, that includes, for example, the employees in charge of a company division, or the heads of marketing or information technology, or the human resources manager. And then there's also the top level managers, which include the C-suite, the CEO, which is the chief executive officer, or the CFO, the chief financial officer. So this section is going to explain the purpose of managerial accounting, which is also called management accounting, and it compares it with financial accounting, which is what you learned in Accounting 201. So if you watched my intro video, you'll remember that the purpose of managerial accounting is a combination of needing to get to the truth and also understanding how certain decisions or changes will impact the future. So we also have this concept of planning versus control. Planning is the process of setting goals and making plans to achieve them. And control is the process of monitoring and evaluating the organization's activities and employees. Now, managerial accounting differs from financial accounting in the following ways. The users of the accounting information. So financial accounting information is provided primarily to the external users, including investors, creditors, regulators, while managerial accounting information is usually provided to internal management, like the executive employees, like the people we just spoke about. There's also the purpose of information is different. The external users of financial accounting information often decide whether to invest or to lend money to a company, whereas internal decision makers decide whether or not they use the information to understand, analyze, plan, control all the company's internal activities. Flexibility of reporting, the financial accounting follows the concept and rules known as GAAP, if you remember that from 201. That provides consistency and comparability between financial statements. Managerial accounting provides internal information, and it's much more flexible and not as rules-based because, it's for internal use. When we think about the timeliness of information, the financial accounting provides information to external users following required time periods like annual, quarterly, depending on if you're public or private company, whereas management internally provides information however much they want as they request it. They might want to see stuff weekly, they might want to see stuff monthly. Then there's the concept of time dimension. So the external users of the financial accounting information, they get historical reports using information that is often months old, whereas internal users, the management of the company, they get real-time data, and they get to use that data to evaluate their current performance, their plan for the future activities, and they can make forecasts and projections based on this real-time data. Then consider the focus of the information. External users will use the financial data often to focus on the performance of the company as a whole for, again, investing or lending decisions. But the internal users, like management, they often focus on specific activities like a product, a department, division that they're responsible for, things like that. And finally, we get to the nature of the information. So both financial and managerial accounting reports have monetary information. Managerial accounting reports also have non-monetary information, non-financial data that I was talking about earlier. That can include things like employee satisfaction, percentage of on-time deliveries, employee diversity, things like head count, stuff that is not necessarily a financial number or a number that has to do with money, right? Fraud affects all business and is costly. The Association of Certified Fraud Examiners estimates that the the average U.S. business loses about 5% of its annual revenues to fraud. There are three factors that push a person to commit fraud, and they are opportunity, pressure, and rationalization. And this is better known as the fraud triangle. The key to stopping fraud is prevention. It's much less expensive and more effective if you prevent fraud rather than detect it and have to address it later. That's why companies nowadays will implement internal controls, and that is to ensure reliable accounting, to protect their assets, make sure that people are following company policies, and ethics are upheld. Ethics. Ethics are beliefs that distinguish right from wrong in the most simple form. Ethics are just beliefs that distinguish right from wrong. The Institute of Management Accountants, that's the professional association for management accountants, they require that management accountants be competent, maintain confidentiality, act with integrity, and communicate information in a fair and credible manner. I spent over a decade as an auditor, and the fraud triangle is something we spend a lot of time on. Quickly to touch base on career paths, managerial accountants are highly regarded, and the professional standing is sometimes denoted by a certificate. Managerial accountant skills are highly valued and useful in many careers. If you watch the intro video, you'll remember that I said managerial accounting in general, but managerial accounting really translates to a lot of different professions and career paths. This could include careers in marketing, management, entrepreneurs, and key decision makers. And this slide actually has an exhibit down below that shows some of the estimated annual salaries from recent surveys. And I will say, just from my personal experience, this is a pretty good representation, but obviously it's going to vary wildly depending on what company you work for, what type of company, how big the company is, if it's a public company versus a private company, and also the location that you're working in. So it's good to do, your research depending on what career path you're looking for. Okay, we're going to switch gears now and talk about the accounting concepts useful in classifying costs. A cost is often traced to a cost object, which is like a product or a process or a department or even a customer. And direct costs are cost effectively traced to a cost object and includes direct materials and direct labor. Direct costs are cost effectively traced to a cost object, and this includes direct materials and direct labor. Whereas indirect costs, they cannot be cost effectively traced to a single cost object. So this would be things that you would maybe consider like overhead. So things like salary for the manufacturing supervisor, or the wages of a maintenance department who cleans the whole factory. Those costs you can't tie specifically to one piece of inventory that was made, for example. So you have direct materials, and those are just the materials that are crucial parts of the finished product. Direct material costs are cost effectively traced through the manufacturing process, all the way through to finished goods. Examples of direct materials are a bike. So let's take a bike, for example. Direct materials would be the tires, the frame, the handlebars, the rubber, the cables, the pedals. All of those things would be direct materials in the manufacturing process of a bike. So then direct labor refers to the cost of the employees. They directly convert materials to the finished product. So therefore the direct labor costs are the wages and the benefits costs that relate to the manufacturing process of the finished goods. So examples of direct labor would be like the operators directly involved in converting those raw materials into finished products. So the welder or the painter for the bike, or the person who attaches the pedals and the brakes in the assembly process. So any costs associated with them doing their job, that would be direct labor costs. So I mentioned overhead before. So there's this concept of factory overhead. It's also known as manufacturing overhead. So this consists of all the manufacturing costs that are not direct materials or direct labor. So factory overhead are the manufacturing costs that cannot be cost effectively traced to the finished goods. This would include things like indirect materials or indirect labor or other indirect costs. For example, if you have indirect material, this would be something that you can't trace to an individual finished good. This would be something like the screws or the nuts that are used in assembling a bike, the staples or the glue that are included in something like when you manufacture shoes or something like that. Indirect labor is the labor that's needed in the manufacturing, but again, it cannot be traced directly to a finished good. So an example of this would be like the cost of the workers who are supervising or assisting in the manufacturing process. But again, you can't trace it specifically to one finished good. Then there's indirect other costs, which this would be things like your utilities, like water, gas, electricity, even like your factory rent and depreciation. Those would fall under factory overhead, indirect other costs. So the product costs are categorized into either a prime cost or a conversion cost. And you'll see on the slide here that there's some overlap. Direct labor is the one that overlaps. So your prime costs include both direct material and direct labor, whereas your conversion costs, as the name suggests, are the costs that are used in converting the raw material to the finished goods. So that includes both direct labor and factory overhead. And then you have the terminology of product costs. So those are all the production costs that are necessary to create a product. So that would include all the things we talked about: direct materials, direct labor, and factory overhead. Then you have this concept of period costs. Those are non-production costs, but they're still associated with the time period during which you're completing the manufacturing of your products. So this could be things like your selling expenses, your general and administrative expenses. You'll see those in the income statement, but they're not tied specifically to a product and therefore don't end up in cost of goods sold. Period costs are still linked to the time period in which you made your product. So, during the year, you're still going to record costs that have nothing to do with actually making the physical product. So like your sales staff that goes out to sell the product, or that comes up with your advertising, or your general and administrative staff like the secretaries and supplies expenses that the whole company uses, including the accountants. Like I always say that as an accountant, we're a cost center, we're not a profit center a lot of times. The accountants of a company, their salaries are going to fall under general administrative expenses usually. Product versus period costs in a little bit more detail. The product costs are production costs necessary to create a product and consist of direct materials, direct labor, and factory overhead, like we said. The product costs are added to inventory or capitalized during the manufacturing of products. So when the products are sold, that's when the cost gets expensed out as cost of goods sold. Now, period costs, they're non-production costs, and they're linked to a specific time period, but not a specific product. So the period costs are expensed in the period when incurred, and they're reported on the income statement either in the selling expenses or in the general and administrative expenses section, the G&A section. Common examples of this would be, like we talked about, advertising costs, delivery costs, the salesperson's salaries, commissions, travel, and G&A expenses would be things like office accounting, office employee wages, the office rent, the depreciation on the office of building and equipment, the office management's salaries, things like that. So period costs go directly to the current income statement as expenses. So they're never reported as an asset. They're never capitalized into the cost of inventory on the balance sheet. Whereas product costs, they are going to be first capitalized in the balance sheet as inventory. Now, their final treatment, those costs' final treatment, depends on when the inventory is sold. So inventory that is sold in 2021, those costs would be recorded as income statement cost of goods sold 2021. Now, the product costs that are assigned to the unsold inventory, they're still going to be on the balance sheet in the 2021 balance sheet. Now, if this inventory gets sold the next year in 2022, that's when the product costs get assigned and reported to cost of goods sold in the 2022 income statement. This can be a little bit confusing, and there's all kinds of special rules around what types of things can be capitalized in inventory and not. But that's the general idea and the basics of it. And this exhibit 14.8 here on this slide gives a good little workflow to show you how it works. So manufacturers report 3 types of inventories on the balance sheet: raw materials, work in process, and finished goods. Raw materials inventory is the cost of materials a company acquires to use in making the products. Raw materials that are cost effectively traced to a product are called direct materials, and those are included in the raw materials inventory balance on the balance sheet. Work in process inventory, or WIP, or also known as goods in process inventory, consists of costs of direct materials, direct labor, and overhead for partially completed products. And then you have finished goods inventory. Now this consists of the cost of direct materials, direct labor, and overhead, but these are for completed products. So these are the goods that have completed the WIP process and they are now ready to be sold. The primary difference in the balance sheet of a merchandiser versus a manufacturer is the inventory. So a merchandiser usually is just going to have one inventory category, and that's going to be called merchandise inventory. So that's the kind of company that buys it, holds it, and sells it. Whereas a manufacturer, they're going to have 3 categories, like we just talked about: raw materials, work in process, and finished goods. Now, the current assets section of a balance sheet is going to look different for merchandising and service companies compared to a manufacturing company, because a merchandiser will report only merchandise inventory, and the manufacturer will report on their balance sheet all 3 types. Sometimes it's reported just in the footnotes, all 3 types, but no matter what, they have to show how inventory falls into each of those 3 categories when you're a manufacturer of goods. And on the income statement, again, the main difference is going to be the content of cost of goods sold. Again, it all ties back to inventory. So on an income statement, those costs that we've been talking about related to inventory, the main difference between a manufacturer and a merchandiser, again, it's just going to be related to the cost of goods sold. It all comes back to inventory. So merchandisers add cost of goods purchased to the beginning merchandise inventory, and then they subtract ending merchandise inventory, and that's how you get to cost of goods sold. But manufacturers, they add cost of goods manufactured to the beginning finished goods balance, and then they subtract the ending finished goods balance of inventory, and that's how they get their cost of goods sold when you're just trying to calculate it like that on the income statement. The key differences on the income statement includes merchandisers have merchandise inventory while manufacturers have finished goods inventory. Merchandisers have the cost of merchandise purchased while manufacturers have the cost of goods manufactured, and that's going to include the direct materials, the direct labor, and the factory overhead. Since a service company doesn't make inventory or buy inventory to resell, it doesn't have to report a cost of goods sold at all. Anything that goes into their gross profit calculation would just be called cost of sales. But generally in the service industry, it's going to be much lower than in a manufacturer or merchandiser. Okay, so now we're going to look at the flow of manufacturing activities. So looking across the top row, the activities flow consists of materials activity, followed by the production activity, followed by the sales activity. The boxes below those activities show the costs for each activity and how the costs flow across the three activities. Okay, so let's look at materials activity. The manufacturers usually start a period with beginning raw materials, and that's the inventory that's left over from the end of the prior year. So then they buy more raw materials in the current period. So adding these purchases to the beginning inventory gives you a total raw materials available for use in production. And then those raw materials are either used in production or you didn't get to them, so they're just still sitting there in raw materials inventory and they can be used in the future. So now let's think about production activity. The manufacturers usually will start the period with a beginning work in process inventory, and that's just equal to the cost of partially completed products from the prior period, and then you add the cost of direct materials, direct labor, factory overhead, basically any cost that is incurred in making the product in the current period. So the production activity results in products that are either finished, so you either got done with it all the way and you move it to finished goods, or at the end of the period, it's still sitting there because it's not done yet. So it's still sitting at ending work in process. So the total cost of direct materials, direct labor, and factory overhead for the finished products, that's what makes up cost of goods manufactured. So that amount is carried over to the current period income statement in the computation of cost of goods sold. So now if we look at the three columns, the cost of the direct materials, direct labor, and factory overhead for the unfinished products, that makes up the ending work in process, and that amount gets carried over to the current period balance sheet. Now when you have sales activity, the cost of the beginning inventory of finished goods plus the cost of newly completed units, the goods manufactured like we just talked about. Now that equals the total finished goods available for sale in the current period. Now the cost of the finished products sold is reported on the income statement as cost of goods sold. The cost of any finished product that's not sold is just going to be sitting there in inventory on the balance sheet and reported as a current asset. Finished goods inventory is what it'll be called on the balance sheet. I know this can be kind of confusing the first time you go through it, but once you kind of go through an example and take it all the way through the process, it'll start to make a little bit more sense. Okay, so let's break it down and look at the individual schedules. So the schedule of cost of goods manufactured. Managers of manufacturing firms will analyze the product costs, and their aim is to make better decisions about materials, labor, and overhead, right? And they want to reduce the cost of goods manufactured because that will improve income. So your manufacturing activities are described in a report called the Schedule of Cost of Goods Manufactured. It's also called the manufacturing statement or the statement of cost of goods manufactured. The Schedule of Costs of Goods Manufactured, it's going to list the types and amounts of costs that are incurred in the manufacturing process. So this schedule is divided into 4 different parts. Your direct materials, your direct labor, factory overhead, the computation of cost of goods manufactured. So number 1, compute the direct materials used. So add beginning raw materials inventory of $8,000 to the purchases of $86,500 during the year, and that gives you $94,500. So that's the raw materials that are available for use during the year. Now, at year end, most companies will do an inventory count. So when they did their count at year end, it shows that they have $9,000 in ending raw materials inventory. So if $94,500 of materials were available and $9,000 of materials remain, then that means that $85,500 of direct materials were used during the period. So number 2, you're going to compute the direct labor used. So your total direct labor costs are $60,000 for the period, and basically the way they come up with that is the wages plus payroll taxes plus the employee benefits that are assigned to those workers that make the bikes. So all those add up to give you your direct labor. Okay, then let's look at the third one. This is where they compute the factory overhead used. So this schedule is going to list out each factory overhead cost. So all of these costs are indirectly related to the manufacturing activities. So the period expenses that we talked about earlier, the SG&A expenses, selling and general and administrative, those are not reported here. So this shows that the total factory overhead was $30,000 for the year. So now, the last step is compute cost of goods manufactured. So you take your total manufacturing costs, which is the $175,500. That's the $85,500 plus the $60,000 plus the $30,000. So that's $175,500. The sum of direct materials, direct labor, and overhead. So then we take the $175,500 and we add the $2,500 beginning WIP, the work in process inventory. And that will give you your total WIP of $178,000. We then subtract $7,500 of ending work in process inventory, and that gets us our cost of goods manufactured. So our cost of goods manufactured is also called the net cost of goods manufactured or the cost of goods completed. So basically what you're trying to get at is how much did it cost for us to manufacture these finished goods inventory. Management uses the schedule of cost of goods manufactured to plan and control their manufacturing activities. So, to provide timely information for business decisions that the managers have to make, this schedule is usually prepared on a monthly or weekly basis. Sometimes they even prepare it on a daily basis. One of the important calculations is the cost per unit. So managers use the schedule of cost of goods manufactured to help estimate the per unit costs. So for example, Rocky Mountain Bikes makes 1,000 bikes during the year. The average manufacturing cost per unit is $170.50. And that's because it was $170,500 to produce 1,000 bikes. Become very important, especially when you're trying to do things like a break-even analysis or understanding how many bikes do I have to make in order to reach a certain amount of profit, things like that. So again, all this cost information is used in the financial statements. So this exhibit here, 1415, it shows how the product costs affect the financial statements. Direct materials, direct labor, overhead costs are included in the schedule of cost of goods manufactured. The cost of goods manufactured from that schedule is used to compute the cost of goods sold on the income statement. So the ending work in process inventory is carried over from that schedule to the balance sheet, and both the balance sheet and the income statement is going to include finished goods inventory. That is all that I'm going to cover for chapter 14. Thanks for listening, and I will see you guys on the next video.